Hey folks, welcome to a brand new episode of Smart Money. Now in this episode, we're going to talk about ways and means to build a sustainable long-term wealth creating portfolio. And in a challenging environment like this, where we perhaps are heading into a recession in the global markets, things are looking a bit sticky on the equity front. This is, I guess, topical to talk about how to not just build, but to even protect your portfolio in these challenging times. We have with us Ajay Tyagi of UTI AMC, who's joining me on the show as my guest today. Ajay, welcome to the show. Thanks a lot for being with us. These are hard times, right? So how should investors really look to build their portfolios for the long term, given that there is so much noise in the markets and different sectors and different companies do well at different points of time?
Yeah, good afternoon, Sonia, and thanks for having me on the show. I would just start by saying that the golden rules of investing haven't really changed over the last 100 or 200 years. And obviously, over the last century, we know from our history textbooks that things have been volatile every other decade. If we just, go back and refresh our memories of the last 20 years, I don't think there was ever a time frame when we could have said that everything is hunky-dory. There is nothing lurking out there, which could be a potential risk factor for the market. So, one has to always go back and say that while things would be uncertain, the world has been an uncertain place and would be an uncertain place. What are the real golden rules for creating a strong portfolio which is able to withstand such kind of events that keep coming in? You talked about recession. That's the most topical thing, as you rightly said. But there must be something to actually fall back on, which would be able to, take care of such kind of events, which would be, as people say, anti-fragile. And I think it's there that I would say quality investing plays a very, very important role. Quality investing basically can look through cycles. It need not be something which has to be invoked at a particular point of time and to be actually flipped over to embrace something else at some other point of time. I think this is one of those strategies which you can cling on to and hold on to through the cycle and through many decades.
But Ajay, correct me if I'm wrong, right? I mean, it hasn't, the definition of quality investing really changed compared to what it was, say, 10, 15 years ago. I mean, the same companies that have been growing for the last 15 years may not be the leaders of the next, right? Purely because of so much disruption, digitization, new players entering. So just define high quality investing for our viewers.
Sure. I think I'll come back to this question on disruption in a bit, but let's start by defining quality. I think different people would have different definition of quality, but let's just, stick to the most objective definition of quality, which is nothing but the ability of a business to generate return on capital substantially higher than the cost of capital, and that too across the cycle, not at a particular point of time of the economic cycle, but through the cycle, through its various ups and downs. Now, this is when I would say 80 to 90% of businesses get knocked out. Because do remember, not all businesses, in fact, very, very few businesses are able to hold on to their profitability, able to hold on to their return on capital being higher than cost of capital at various points of time in the cycle, particularly during the downturns or I would say recessionary times in any economy. So I think that's the most dependable definition. One can look at the behavior of businesses in 2008 and 9 when the world was struck by the financial crisis. One should look at the behavior of businesses during 2020 when the world was struck by another unexpected event called the pandemic. And if you are able to figure out businesses which even during the most, I would say, punishing circumstances have been able to deliver strong profitability, then they really must be high quality businesses.
Yeah. Okay, so once you select a company, right, to invest on based on quality and growth parameters, so companies that have perhaps survived the crisis, survived the pandemic, how do you go about constructing your portfolio? How much is the influence of the benchmark?
No, that's a very good question. I would say that quality investing itself can be actually practiced in many different ways. I would say that the one that comes naturally to us is to be agnostic of the benchmark, not look at the benchmark at all and truly be bottom up in the portfolio construction approach. Because if you look at the benchmark, then you sometimes can actually get caught down by these heavy weightage sectors, which may not qualify as sectors which possess or which have high quality businesses in them. But you still would want to actually own one or two businesses so that you don't go too divergent from the benchmark or too divergent from the outcomes of the benchmark. So I would say the best way to exercise the quality strategy is to be bottom up. Don't look at the benchmark. Just look at those businesses which will help you in your wealth maximization. And I think history and data tells us that businesses which have strong return on capital and therefore strong cash flows and have the ability to reinvest these cash flows at a very healthy rate are eventually the ones which create strong wealth for their patient investors. Do remember, the operative word here is patience.
Sure.
You really have to stick on to them through thick and thin.
Okay, let's take an example here, right? Just trying to play the devil's advocate. You said that quality investing should result in wealth maximization and one should have patience. Case in point, right? ITC. Great company, strong pedigree, no red flags, but the stock, I mean, you'd call it a quality stock by definition, but it has done nothing for investors. Now, of course, this year was a turning point, but the last 10 years, the stock has done virtually nothing. Your thoughts on how does one approach it at a time like this?
No, absolutely. You've picked up the right example, Sonia. ITC would still qualify as a high quality business. Of course, it churns out huge amount of cash flows every year effortlessly. But the point here is, I also mentioned about ability to reinvest these cash flows back very, very profitably. I think this is where ITC has been facing a challenge. If you look at the history of this company over the last 40, 50 years, it sure has been a great wealth creator. Has it been a great wealth creator over the last 10 years? Answer is no. And this is where you have to dig in a bit deeper and realize that cigarette consumption in this country has actually been declining. This is not a business which can actually experience volume growth in its core business, the core business which really generates these cash flows. This business is not going to grow at 6, 7, 8% volume growth. Volume growth could possibly be flattish. And I think that's the most important reason that one must actually look at when you're searching for quality along with sustenance of quality by way of reinvesting these cash flows for future growth. So I think it's the second part which is missing in companies like ITC, and it's not alone. I think in that camp, there are many other high quality businesses which now have this inability to experience a long growth runway, and therefore they just fall off the radar in terms of prospective wealth creation.
So how long do you wait? I mean, how do you know? So someone who is perhaps invested in ITC, they would hold on to it, right? But then there's an opportunity cost. I mean, you'd rather have put that money elsewhere in a high growth stock. At what point do you decide that, okay, now this stock has fallen off the radar, so even if it's good quality, I'm going to let it go?
I would say, Sonia, first of all, one has to de-anchor oneself from the price at which they have bought any particular stock. I think that's the biggest mistake which many of us make. They just feel that, look, we bought a stock at a price of 100. I know that the prospects for this business are very poor, but the price is 70. Let me at least wait back for the price to reach back to 100 rupees, and then I'll sell it off. I think you really wait only till the point that the data around you is not supportive of the original hypothesis that you had for this business. So let's say the original hypothesis for HDFC by an investor was written in the year 2000, and it was about the fact that cigarette business is really the core heart and soul of ITC. It continues to grow, it continues to show very strong margins and cash flows, and I think this will keep compounding at the rate of, let's say, 14 or 15%. By the time you reach 2014 or 15, you realize that possibly this is not happening, and you therefore wanted to dig deeper into why is it not happening. And if in the next couple of years you realize that, look, this is not happening because the number of smokers in the country are reducing, or the frequency of existing smokers is also going down, then this is something which is really going to hurt the business in the long term in terms of the growth of these very cash flows that we liked in the first place and because of which we wrote this hypothesis. So I would say that's the point, when the data around you is not supportive of your hypothesis, that you would want to bail out, regardless of your entry price and regardless of what the current price is. Yeah.
Okay, fair enough. That's a fair point. Let's do one thing. Let's take a quick commercial break. We have lots more to talk about on smart money, so don't go anywhere. We'll be back in just a bit. Stay tuned. Welcome back. You're still watching Smart Money on CNBC TV18. Still with us is Ajay Tyagi of UTI AMC, and the topic at hand is sustainable wealth creation in challenging times. Ajay, before the break, we were talking about ITC and how one should sort of look at growth companies, but then there should be a hard stop. Once you notice that the company is not performing, then perhaps it's time to let go. Such high quality and high growth businesses usually trade at very expensive multiples as well, right? How do you deal with the issue of valuations? Even if a stock is highly valued, but if the stock is doing well, if there are no red flags, if the pedigree is strong, no corporate governance issues, do you still stay with it or do you move on?
Sure. I think, Sonia, we'll have to divide this question into two parts. Everything when it comes to investing has to be seen in the context of the time frame that the investor has. And I would say that this question of valuation becomes very, very pertinent if the investor is only having a 1 or a 2 or a 3-year time horizon. But actually, this question of high valuation fades away if you have a time frame of 5 years, 7 years, and 10 years. Because what matters in the long run, 5, 7, and 10 years, is not really the starting valuation. Of course, the starting valuation would have consequences on the overall return that you make, and I'm not refuting that. But I think over a longer term horizon, what matters the most is the quality of the franchise and the ability of that franchise to continue growing at a very healthy rate and continue growing very, very profitably while it's enjoying those strong growth rates. But if your time horizon is very short, then I think valuation becomes a very, very important point to ponder over. The second part of your question is, do these high quality, high growth companies, if trading at a valuation of 40, 50 times, basically mean that they are too expensive, even from a longer term perspective? I would say that the price earnings multiple, which is the shorthand for valuations, quite frankly, if you ask me, because that's the most convenient metric we all use, itself is related to the return on equity of a business and the sustainable growth rate of a business. I don't want to get too technical on this show, but if you dissect price earnings multiple, what you would realize is that the two most important variables which are impacting the PE of any business are its return on equity and its growth. And it's a positive relationship with these two factors. If return on equity is high, price earnings multiple will be high. If growth rates are high, again, price earnings multiple would be high. And by the way, if both, which is ROE and growth, are high, then PE can be even higher. So, the shorthand tells you.
Sure, can we take an example here? Because I do have two charts that I want to pull up. One is Jubilant FoodWorks, right? The classic example of a great business, high growth, but very expensive valuation. So here we have the chart from March of 2013, and this is all the way to September of 2022. There is a 49% correction that we've seen from the top, perhaps at extremely high valuations. So you have to be sort of prepared, Ajay, with that kind of correction because of a valuation discomfort, right? So the question that I'm asking is, how do you know when is the right time to be buying the stock? I mean, if you had bought way back in March 2013, the correction wouldn't have really impacted your profitability. But if you had bought a little later in the cycle, then you would have been sitting with steep losses. What do you do then?
And this is where, Sonia, my reply to your question, the first part of my reply to your question is very important. Are you in this for a 5-7 year period? Are you in this for a 1 or 2 year period? Because if you are in this for a 5 or 7 year period, then whichever point you embark on, and you can continue taking Jubilant as an example, whether you embarked on Jubilant in 2013, 14, 15, 16, 17, if you were having the patience to hold on to it because your hypothesis that you had written about the business was still valid, you would have made money regardless. Don't forget that despite falling 50% in the last 9 months, the long-range CAGR, the 10-year CAGR for Jubilant still remains a very healthy 25%. There are very few businesses which can give you that kind of a return sustainably. So I think the important thing, and I'm coming back to this, is to keep testing your hypothesis. Does Jubilant really remain a great franchise? Does Jubilant have the ability to increase its number of stores from let's say 1100 to 2000 over the next 5-7 years, does Jubilant have the ability to actually have more streams of growth coming in by launching new categories, which by the way they have recently launched? So I think these are the more important questions rather than just fretting about, look, is it too expensive? Can I just book some profits here and wait for a couple of years before it gets more cheap? I think a pure quality investor is always looking at the business outcomes rather than fretting about, can the stock price correct more than the market? Yeah.
So we have another chart, right, that I do want to pull up, which is the chart of Info Edge. And if you look at that, of course, Info Edge has had a one-way rally all the way from March 2013 to it's almost a one-way rally actually till 2021 or so. But then the correction, it halved. It was a 52% correction that we saw. What do you do with a company like this? I mean, does the same argument that you made for Jubilant, does it hold for Info Edge as well?
I would say absolutely. And I didn't point this out when you were pulling up the charts on Jubilant. Jubilant too has gone through a massive 35%, even a 50% drawdown in the middle of last decade. So it's not unusual for growth stocks to witness a 30, 40, 50% drawdown. I would say it's par for the course. You can look at not only high growth companies, high quality companies here in India, but even globally, the Googles of the world, the Facebooks of the world, all of these Microsofts of the world, all of these businesses do have sharp drawdown once in a while. Now, so for InfoEdge as well, what we are looking for is the ability of the business to hold on to leadership position in its core recruitment business, whether the business can actually improve its leadership position in the real estate vertical. Can real estate vertical be a much bigger revenue driver for InfoEdge in the coming years and decades? And also the kind of patient long-term investments that InfoEdge has been very successful about when they invest into certain internet-related themes at the infancy itself. So I think these are the drivers for InfoEdge, and this is what we keep testing for, rather than just looking at are they overvalued, and if yes, should we just exit and then try and look for a more attractive price? We are more focused on channelizing our energies and attention to business outcomes rather than just valuations.
Okay,
that's typically how a quality
Sure.
manager would operate.
Sure. Okay, with such a strict focus on growth and quality, right? Are there enough opportunities available in the market now? Or do you feel that there is some constraint? Because it's very hard to find companies that are high growth and still are relatively okay on valuations.
Absolutely, I fully agree. But I would also want to take you back 100 years when the famous economist Pareto wrote the 80-20 law. And I think that law is applicable for every walk of life. And I think it's applicable for investing as well. History shows us, whether it's the Indian markets or developed markets, that barely 10 to 15% companies are able to really create all of the wealth. And I think when you look at the Indian markets over the last 20, 30 years, you would agree with me that there certainly have been less than 100 companies which have really created that sustainable wealth. So, I always consider this to be a very, very important starting point. It basically guides us that we don't need to fish in all the ponds. We really need to be doubling down and fishing into those ponds where the probability of finding out the long-term winners is very, very high. And this pond is what I've just explained. The economic characteristics of such businesses are high ROCs, ability to reinvest, long growth runways, very, very strong balance sheet with low to no debt, strong cash flow generation, and so on. If you can concentrate on this set of companies and be very, very focused in terms of picking out winners, your probability of actually generating long-term wealth to our mind is high.
Okay, that was a very, very helpful explanation, and it's something that perhaps people are aware of, but they need a reminder time and time again, right? The wisdom or the pearls of wisdom with regards to wealth creation. Ajay, thanks a lot for joining in. Have a great day. Well, that's a wrap, but before we wrap up, we have a financial tip of the week for you. And today's financial health tip is, what is an income fund and what are the benefits of investing in income funds? Now, the objective of an income fund is to provide regular and steady income to investors, An income fund basically invests in fixed income securities, whether it's corporate bonds, whether it's debentures or even government securities. Now, the fund's return is from the interest income that's earned on these investments, as well as the capital gain from any change in the valuation of the securities. The fund will distribute the income provided to the portfolio, generates that kind of required returns. Now, there is no guarantee on the income, and the returns will depend upon the tenor and the credit quality of the securities held. But the biggest advantage of an income fund is high liquidity. Unlike some fixed deposits, income funds do not have any lock-in period, and they allow investors to withdraw their investment anytime. However, exit loads may be imposed for redemption in these funds from a 1 to 3 year period. Well, that's your financial health tip of the week. Keep it with CNBC TV 18. Thanks a lot for watching Smart Money.